Hello everyone. Welcome to EduTap and welcome to today's session. So the RBI has released the annual report of the Reserve Bank of India 2025-26. This is a very important report of the Reserve Bank of India, and the important chapters we have discussed. We have started the discussion on the annual report of 2025-26 in the previous session. I hope you have already seen that session, and today we are going to conclude our discussion on the annual report. So the comprehensive discussion has been done, and we are going to conclude the discussion. With that, we are also going to discuss the MCQs. Okay, so give me a thumbs up if I'm clearly audible and the screen is visible. Everything is fine, I hope. Everything seems fine. Okay, so let's start with today's session and the annual report. This is a very important report of the Reserve Bank of India. I don't think I have to tell you the importance. If you are giving the RBI Grade B examination, the annual report is a very important report for the phase 1 as well as for the phase 2. Okay, so let's get started without any delay. Today we will discuss the different chapters that are left, as well as we will discuss some MCQs so that you have the clarity that what kind of questions can come from this particular report. Now let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. And the link for the Telegram channel is provided in the description box below. Okay, so you will get the PDF of the session. You don't have to worry about it. Chalo, let's get started now. So in the annual report, we have already discussed the part 1. That is a very big part, and here a lot of data you have to remember. Then we have also discussed the monetary policy operations, credit delivery and financial inclusion, financial markets and foreign exchange management, and the Reserve Bank account for 2025-26. We have got the overview of these chapters. Now these are the 6 chapters that are left, but let me tell you that in these chapters, we only need to have an overview. Like for the part 1, we needed to have a detailed discussion. But in the part 2, in these 6 chapters, we only need to have the overview. So I've brought the important points, as well as I have highlighted the points that you have to keep in mind, that you have to remember from the examination perspective. Okay? So these 6 chapters we are going to discuss today. We will have an overview. So I will try to finish it in a faster manner. So let's get started. So these I hope you have seen in the previous session. I hope you have already seen the previous session. If you have not, then do go and see the previous session first, so that the previous chapters are clear for you. Okay. Now let's start with the chapter 6. So we are starting with the chapter 6, that is regulation, supervision and financial stability. Now the chapter 6, it is all about the regulation, supervision and financial stability. So here we will discuss about the different departments of RBI and what initiatives they have taken, what steps they have taken, and what you have to remember from the examination perspective. Chalo. The Financial Stability Department, this is a very important department of the Reserve Bank of India. It works as the secretariat to the FSDC subcommittee. So there is the subcommittee of the Financial Stability and Development Council. So Financial Stability and Development Council is chaired by the Minister of Finance, the Union Minister of Finance, while the subcommittee of FSDC is chaired by the Governor of the Reserve Bank of India. Okay? And this subcommittee of the FSDC, this subcommittee of the Financial Stability and Development Council, it is the committee that releases the financial stability report in consultation with the different regulators. Okay, so the Financial Stability Department of the Reserve Bank of India, it works as the secretariat to the Financial Stability and Development Council subcommittee, which looks into the matter of financial stability, financial sector development, and interregulatory coordination. So the Financial Stability Department, it brings out half-yearly financial stability report, which presents the subcommittee of FSDC's collective assessment of key macro financial risk to stability in India. I hope you already know about the Financial Stability Report. It is another very important report that is released by the Reserve Bank of India Financial Stability Department, which is a secretariat for the subcommittee of the FSDC. Now, the subcommittee of FSDC, it is chaired by the Governor of Reserve Bank of India, and in this subcommittee, the chairman of SEBI, the chairman of IRDI, PFRDA, all these important regulators, their heads, they are present in this subcommittee of FSDC. Okay? Now, the subcommittee of FSDC, with consultation with the different regulators, there is the financial stability report that is prepared by the Financial Secretariat by the Financial Stability Department. So this is the overall idea. The Financial Stability Department, it is the secretariat of the subcommittee of FSDC which releases the Financial Stability Report. Now, this department using Scope 1 emission data. So the Financial Stability Department using the emission data of the listed companies assessed the impact of climate transition risk on carbon intensive sectors. So there are certain carbon intensive companies, there are certain carbon intensive sectors that are releasing a lot of carbon emissions and such. So if they have to transition towards the cleaner fuel, towards the cleaner energy, there is a climate transition risk. So the department, the Financial Stability Department, using the Scope 1 emission data. Scope 1 emission data means the emissions that are occurring from the sources of these listed companies. So the department using Scope 1 emission data of listed companies assess the impact of climate transition risk on the carbon intensive sectors and the risk that are on these companies, that are the carbon intensive companies. So these risk on these companies, they will also affect the banking sector, they will also affect the banks, because banks have given a lot of loans to different companies, right? So the banking sector will also come under the climate transition risk if the companies are under the risk. So the department using the data have assessed the impact of climate transition risk on the carbon intensive sectors and the banking sector. As well as the department has also the department is also developing a model using IMF's growth at risk model. So using the IMF's growth at risk model, the department is also creating this kind of model to evaluate how financial vulnerabilities could affect the India's future economic growth. Okay, so this is the broad idea. So what kind of data has been used? Scope 1 emission data has been used for seeing the impact of climate transition risk on the carbon intensive sectors and how this will impact the banking sector. As well as the Financial Stability Department, it is also developing a model using the IMF's growth at risk model to see the financial vulnerabilities, how they can impact the India's future economic growth. Now next is liquidity stress test. Like I hope you remember that in the FSR there is in the financial stability risk, there is also the stress test that is released for the scheduled commercial banks. The stress test, it is released for the NBFCs, that in the baseline scenario what will happen in the stress scenario, in the medium stress, in the higher stress, what will happen to the scheduled commercial banks, how much of the capital adequacy they will be able to maintain and such. So it has now been said that the liquidity stress test framework for NBFC is at the advanced stage of development. That is for the NBFCs, there is the liquidity stress test that is being developed, so that the test can happen that in the future, in the baseline scenario, in the scenario, in the stress scenario, what will be the liquidity that the NBFC will be able to maintain. The department has explored the feasibility of developing the macro stress test, like in the baseline scenario, in the stress scenario, the macro stress test, it sees that in the future what will be the condition of the particular banking uh, category. Okay, so the department, the Financial Stability Department, has explored the feasibility of developing a macro stress test framework for the urban cooperative bank sector, especially tier 3 and tier 4. So tier 3 and tier 4, they are the largest of the urban cooperative banks. That's why it has been said that for them, for these urban cooperative banks that are very large urban cooperative banks, for them there will be the macro stress test that will be developed, okay, in line with that of scheduled commercial bank. So liquidity stress tests, they are being developed for the NBFCs, and the macro stress test, the development of them are being explored for the urban cooperative banks tier 3 and tier 4 specifically. Now moving forward, the RBI's August 2025, so last year, the guidelines were released for the non-fund based credit facilities. Credit facilities means the banks are giving loan. So they are fund based, where the fund is being released. Okay? These are the fund based credit facilities. Non-fund based credit facilities means guarantees are being given by the bank on your behalf, or the letter of credit is being given. So these are the non-fund based credit facility. The bank is giving guarantee, the bank is giving the partial credit enhancement and such. So basically, under these guidelines, these were the guidelines for the non-fund based credit facilities, like the guarantees for them. The guidelines were released. So it recognized the electronic guarantees, introduced the prudential safeguards while providing the guarantees, or while providing the non-fund based credit facilities, including specific limits on the issuance of guarantees by cooperative banks, regional rural banks, and local area banks. For these particular banks, for the cooperative banks, RRBs and LABs, there were the limits that were specified. Okay. for the guarantees, expanding the entities that can provide the partial credit enhancement. Okay, that is a credit enhancement facility. So which entities can provide the partial credit enhancement? So there was the uh, increase of the entities that can provide the partial credit enhancement. So basically last year these guidelines were released. Now next is under the consolidation of regulations exercise, more than 11,000 instructions were consolidated into 244 master direction across 11 types of regulated entities, and now it has been said that these master directions will serve as the sole library of regulations, as the sole library of the regulations. Okay, now next is Financial Reserve Bank of India. So the Department of Regulation, it released the non-fund based credit facilities directions. It has also consolidated a lot of instructions into the master action. Next is that the Department of Regulation released the asset classification, provisioning and income recognition directions that we have discussed. Now these directions are released in April 2026 and they are applicable from April 2027, in which the expected credit loss framework has been adopted, in which the stage 1, stage 2, stage 3, these are the three stages that have been informed. Stage 1 consists of the standard assets that do not have significant increase in the credit risk, and for them the expected credit loss provisions have to be maintained for the 12-month time period. Okay, then there is stage 2, which also consists of the standard assets, but here is the increase in the significant increase in credit risk, and that's why the provisions have to be maintained for the lifetime. The stage 3 consists of the non-performing assets. Okay, again for these the provisions have to be maintained for the lifetime, and expected credit loss provisions, like there is the formula that has been given, as well as the minimum provisions have been informed by the RBI, that in stage 1, stage 2, stage 3, these are the minimum provisions. As well as with this expected credit loss model, there is also the introduction of effective interest rate method that will also be applicable from April 1, 2027 for the new loans, and for the outstanding loans the effective interest rate have to be adopted uh, within, like, by 31st March 2030. I hope all of this you remember. Okay, now moving forward, co-lending, so last year, so this is introduced this year, that we have like in April 2026, the asset classification, provisioning, income recognition norms were informed. But last year there was the introduction, like in August 2025, there were the directions that were released for the co-lending, okay, in which it was said that the regulated entities, before the regulated entity, it needed to have the minimum share in a co-lending arrangement where the different entities are doing the co-lending, they are coming together, they are doing the co-lending. So in the co-lending arrangement, before, the regulated entity needed to have a minimum share of 20% of the loan, but now it has been said that the regulated entity needs to only have the 10% of the share in the co-lending space, as well as the default guarantee, the first loss default guarantee cannot exceed 5%, it can only be up to 5%. Okay, so if the default first loss default guarantee is being given, that what if the borrower defaults, so if the default guarantee is coming, that will be only up to 5%. That is the idea. So remember that for the there is the minimum share of individual loans. In this, the regulated entities share has been reduced from 20% to 10%. So now the regulated entity can have a minimum share of 10% in the co-lending arrangement, and the first loss default guarantee cover is only up to 5%. Next, RBI's revised capital charge for credit risk. This is the direction that has been released again in April 2026, but we have to discuss it. We will discuss it in the marathon session, or we will discuss it in detail. If I get to take a separate finance 360-degree session, then I will discuss this with you, because this is released in April 2026. So RBI has revised the capital charge for credit risk standardized approach under Basel III, under which the risk weights have been modified, or there are the modified guidelines for the risk weights. Okay, so this is the direction that is released in April 2026 on May 2026. So this is the direction that we have to discuss. This we will discuss in detail in another Finance 360-degree session. Next is NBFCs. I hope you remember that the NBFCs, for them the directions were released that they are divided into type 1 NBFCs and type 2 NBFCs. In the type 1 NBFCs, there are the registered and unregistered. So type 1 NBFCs, they are non-deposit taking, or they are the NBFCs that cannot avail public funds, they cannot have the customer interface. So type 1 NBFCs that have less than 1000 crore of asset size, they can be unregistered type 1 NBFCs. Okay, so this is the idea that type 1 NBFCs, they are the NBFCs that are not accessing public funds, they are not having customer interface, and if the type 1 NBFCs have less than 1000 crores of asset size, then they can be unregistered or they can be deregistered. RAMS project, that is Regulatory Application Management System project, is being implemented across the Department of Regulation in 3 phases, and the requirement gathering and technical development for phase 1 has been completed. So basically a new project is being implemented by the Department of Regulation, that is the Regulatory Application Management System. That's it. Next, coming to the next one, last year in 25 April 2025, April 2025, there was the news regarding the Basel III framework on liquidity standards, liquidity coverage norms. They were modified, or they were updated, okay, to align the liquidity coverage ratio norms with the Basel III liquidity standards. Think about it, that see what has happened in the recent time after 2016, especially with the adoption of UPI as well as the RTGS, NEFT. These systems, they have become more they have become more accessible, they have become more prudent. Okay, and with the adoption of the UPI, what is happening that now there is higher runoff factor of the deposits. Before, the deposits, if you had to take out the deposits, you had to go to the bank, you had to stand on in the lines and such. Now what you can do directly, if you want to transfer the money, you can use the UPI, you can use the RTGS, you can use the NEFT system. Okay, UPI has become very accessible, very easy to use, so the people are able to transfer the deposits easily, as well as the withdrawal of the money has also become easier. You can use you can go to the ATM, you can use the UPI facility to also withdraw the money if the debit card is not available and such. So this is the idea, that now it has been said that with internet banking, with mobile banking and such, there is higher withdrawals or transfers. Basically, transfers have become very easy. The transactions, the transfers have become very easy. And that's why the deposits that a bank is having is able to get transferred very in a fast manner. In this way, it was said that the bank should have enough of the liquidity coverage. With the easy accessible way of transferring the money, it is easier to transfer your deposits, and the banks, they will face the liquidity crunch, or they can face the liquidity problem if there is too much of the transfer of the money that is happening from one bank to maybe some other bank. Okay, so in this case, liquidity coverage ratio norms have been updated, and they have been aligned with the Basel III liquidity standards, in which it has been said that 2.5% additional runoff factor for retail deposits and unsecured wholesale funding from non-financial small business customers that have the access to internet and mobile banking access. So runoff factor is basically the transfer or the transactions, so the money can run off from one bank to some other bank, or from one bank to some other account and such. So 2.5% of additional runoff factor will be provided for the retail deposits, as well as for the unsecured wholesale funding for the non-financial small business customers. So for the small business customers that are not in the financial domain, that are non-financial, for them there will be additional 2.5% of the runoff factor if they have access to the internet and mobile banking. Okay, because the money can be easily transferred in this case. Next is haircut on the market values of government securities. Whenever see the government securities, they are being used as collateral under the repo rate. So under the repo rate, under the MSF, the government securities are being used as collateral. So if RBI is lending to the banks, RBI is providing the loan to the banks under the repo rate or under the Martian standing facility. If the RBI is providing the loan to the banks have to provide collateral to the RBI. So RBI is lending to the banks have to provide the collateral to RBI in the form of government securities. Now, let's say the government securities are worth 100 crores. The loan is given with a discount of, or there is a margin that is deducted of 5%, that is 5 crores, and the loan is given 95 crores. So there is a margin that is taken, that the collateral value should be the loan should be 95% of collateral value. The loan should be 95% of the collateral value. So there is a margin deduction of 5%. Similarly, it has been said that whatever is the government securities margin that is deducted for the margin standing facility, for the LAF, for the liquidity adjustment facility, for the repo rate and such, whatever the margin is being deducted of the government securities while they are being kept as collateral. So same haircut, same margin will be applied for the government securities if they are being kept as the high quality liquid asset under the liquidity coverage ratio. That is the liquidity that will cover the outflows of the deposit. Okay, so there is liquidity coverage ratio is basically the liquidity that the banks have to maintain for the outflows that are going to happen in the next 30 days and such. Okay, so for the liquidity coverage ratio, the banks can maintain the liquidity in the form of cash, in the form of gold, in the form of government securities. So these government securities, they will have a haircut. They will have a haircut. That means the government securities value will be taken at only 95% or 80% or 75% or 90%. So haircut on the market value of government securities classified as level 1, a high quality liquid asset, that are the very very liquid assets. Okay, to match margin requirement under the liquidity adjustment facility, under the repo rate facility and the margin standing facility and such. Next is clarifying that other legal entities category shall consist of all deposit and other funding. So this is it. This is all you have to remember, that the 2.5% is the runoff factor, that is for these particular deposits, and the haircut on the government securities that are classified as high quality liquid assets. So for them, the haircut will be same as the margin requirement of the LAF and MSF. Next is framework for regulation of formulation of regulations and regulatory review mechanism. So it was said that there is a broad principle. So basically, principles were laid down. The broad principles were laid down for formulation, amendment, and review of regulations. That how the regulations will be formed, how they will be amended and reviewed. So for that, the broad principles were laid down, as well as there was the regulatory review mechanism, or there was the regulatory review cell that was formed, so that in 5 to 7 years every regulation should be reviewed in 5 to 7 years. So the regulation, like whatever regulations the RBI has made new, or the previous regulations, they should be reviewed every 5 to 7 years. So it was said, for that there was the regulatory review cell that was created, as well as external advisory group on regulation. It was also formed. Okay, chalo. Next is, so this is the framework for formulation of regulations. The directions were released in May 2025, last year, basically, to provide the broad principles for the RBI to how they will form the regulations, amendment of regulations, and review of regulations, so that there is the broad outlay that is present. As well as the regulatory review cell was created, and there was the external advisory group on regulations also. Regulatory review cell every 5 to 7 years have to review the regulations. Like every regulation should be reviewed in 5 to 7 years. Next is default digital lending directions. They were also released last year. It mandates digital view of match loan. So let's say you are taking the loan through a digital lending platform and there are multiple lenders. So whichever is the match loan, let's say you want to have 1 lakh rupees, and at the interest of, let's say, up to 8% for a period of 6 months. So let's say there are multiple lenders with which you have matched. So the digital lending platforms, they have to show the matched loan offers from the multiple lenders, as well as they also need to disclose the unmatched lenders and why they have unmatched. Basically, they are providing the loan at higher interest rate, or they do not provide the loan for this particular tenure. So this is the idea, that digital lending platforms or digital lending directions were laid down, in which it was said that the digital lending platforms, they have to show the matched loan offers and the unmatched lenders also, as well as there is the public directory of digital lending applications that is being operationalized, so that the people can see, the public can see, that which are the actual digital lending applications. Okay, next is digital lending against gold and silver collateral. These directions were also released last year, and basically it was said that you can take the loan against gold or silver collateral. You can take the loan against the gold or silver collateral, and there will be the loan to value ratio. Loan to value ratio means collateral value, let's say it is of 10 lakh, so you will get the loan up to 8.5 lakh. That is, loan to value ratio is 85%. Or let's say you will get loan of only 6 lakh. So collateral value, the collateral loan to value ratio is 60%. You will get the loan that is 60% of the collateral value. This is the basic idea. Okay. So basically for the small value loans, the framework was revised and the loan to value ratio was revised. 85% of the loan to value ratio for loans up to 2.5 lakh and 80% of the loan to value ratio for loans above 2.5 lakh and up to 2.5 lakh, above 2.5 lakh and up to 5 lakh, and the 75% of loan to value ratio for loans above 5 lakh. So 85% of the loan to value ratio for loans up to 2.5 lakh, 80% of the loan to value ratio for loans above 2.5 lakh and up to 5 lakh. Okay. So this is the idea. And 75% of loan to value ratio for loans above 5 lakh. There were the restrictions that were removed on the cooperative banks and RRBs for bullet repayment loans. Bullet repayment loans basically means that let's say you have taken a loan for a 1 year tenure, you will only return the loan and the principal payments will also be paid at the end of the loan or in a bullet manner in a single transfer. This is the idea. Now coming to the next one, that is central the KYC norms. They were also reformed. They were also updated. So central KYC registry has become the first reference point for the KYC. The business correspondents, that is the agents of the banks, the arms of the banks, basically, they are allowed to facilitate KYC updates, as well as it was said that for the low risk individual customers, if they have not updated their know your customer like they have not updated their information which is due and the due date has passed, so for 1 year they can continue their banking operations, or June 30th, 2026, till then they can continue their banking operations without their banking operations being hindered. But like within the timeline, they have to fulfill their KYC norms. Okay. So all transactions are allowed for low risk individual customers, and updation of KYC should happen within 1 year from the due date or June 30th, 2026, whichever is later. Now, coming to the last point that from this particular slide, that is project RBI's project finance directions. They were also released last year. They were particularly for the project finance, the finance or the loans that are provided for the infrastructure projects or for the real estate projects and such. Okay. So here it was said that some of the projects, some of the infrastructure projects, they might delay because of the rainy season, because of the environment, because of the weather conditions and such. So certain projects, they might differ or they might get delayed slightly because of the natural conditions that cannot be stopped. So, date of commencement of commercial operations, deferment, the delay of up to 2 years for non-infrastructure projects, and the deferment of the date of commercial commencement of commercial operations if it is getting deferred for 3 years for infrastructure projects. This was permitted without asset classification downgrade, without considering the loan as NPA. Okay? So it was said that for non-infrastructure projects, how many years of the deferment in the date of commencement of commercial operation? 2 years. For the infrastructure projects, there is the 3 years that is allowed, that if the deferment is only happening till a period of 3 years for from the date of commencement of commercial operation, for such kind of loans it will not be considered as NPA. They will not be downgraded in their asset classification. But if the deferment is more than that, 5 years or something, so then the asset classification might be downgraded. Okay. This is the idea. Chalo. Now coming to the next one, that is Reserve Bank of India interest rate on advances amendment directions 2025. Here basically it was said that the banks are allowed to reduce the spread components. Basically repo rate, as per the repo rate, this is the benchmark rate on which the interest rate for many of the loans depend. As well as there is also the spread component that depends on the cost of operation for the bank or cost of providing the loan for the bank, as well as there is also the risk component. So on the basis of all these, the interest rate is decided. Let's say the interest rate is decided by the bank at 9%. Okay. Now it has been said that the banks can reduce their spread component. The banks can reduce their spread component excluding the credit risk premium. They cannot reduce their credit risk premium because the credit risk premium, it depends on the credit risk of the borrower. Okay. So the banks, they are allowed to reduce the spread component excluding the credit risk premium at a shorter periodicity than once in 3 years. So before it was said that the banks can only reduce their spread component and change their interest rate on the basis of the spread component like in 3 years, after 3 years. But now it has been said that for customer retention, if the banks want to retain their customers, they do not want the customers to go to other banks and such, so banks are allowed to reduce their spread component at a shorter periodicity than once in 3 years. That is the idea. Now, next is scheme for facilitating accelerated payout in operative accounts and unclaimed deposits. So, last year, this scheme was launched for a period of 1 year only by the Reserve Bank of India. This scheme incentivizes the banks to reduce the unclaimed deposits or to return the unclaimed deposits, to find the depositors so that the money can be returned for the unclaimed deposits, as well as inoperative accounts. There are many inoperative accounts, so banks were incentivized to reach out to the customers so that these inoperative accounts can be made operative again. This is the idea. So the scheme this scheme was launched to encourage the banks, to incentivize the banks to actively pursue the customers or the depositors for reactivation of their inoperative accounts and return of their unclaimed deposits. But this scheme is only for 1 year time period, that is from October 1, 2025 till September 30, 2026. Next is gold metal loans. So the scope of the eligible borrowers was expanded to include a wider category of jewelers in under the gold metal loans, and the repayment tenure for the non-exporters was extended up to 270 days, aligned with the working capital cycles. So basically from 180 days of the repayment tenure, the timeline was increased to 270 days. Okay, before the loan had to be returned within 180 days, but now the repayment tenure for non-exporters jewelers, basically it was extended up to 270 days. Next is maintenance of cash credit accounts, current accounts and overdraft accounts. So banks, let's say there is the borrower that has taken loan from multiple banks, okay, under the co-lending arrangement or under the different lending arrangements. The borrower has taken the corporate or the infrastructure project, it has taken the loan from multiple different lenders. So this is a borrower of multiple different lenders. Now it has been said that banks having minimum of 10% share either in the banking system's aggregate exposure to this borrower or the banking system's aggregate fund based exposure to this borrower. So basically if the banks have minimum 10% of share in the borrower's loans. Now, this particular bank, if it has more than if it has minimum 10% of share in the loans of the borrowers, then the bank can maintain the current account and overdraft accounts of the borrower. Okay, so let's say the borrower has taken multiple loans from multiple different banks. The borrower has taken multiple loans from multiple different banks. Now, a bank having minimum 10% of share in the borrower's exposure, only that bank can provide the current account facility to the borrower or the overdraft facility to the borrower. But if the bank has less than this, let's say 7% of share or 5% of share only, so that is less than 10% of share. If a bank has less than 10% of share, then in this case the bank can only maintain collection accounts for collecting the repayments. It cannot have the current account or the overdraft accounts for the borrower. That is the idea. Next is ceiling on continuous. So a mandatory, this is the draft amendment directions. So a mandatory 3 year cooling off period has been imposed for the directors of the urban cooperative banks and the rural cooperative banks. It was said that a mandatory 3 year cooling off period after 10 years of continuous tenure before a director can rejoin the same bank's board. So basically it has been said that if you have the 10 years of continuous tenure, or if you had a 10 year of tenure in a particular bank, in a urban cooperative bank, rural cooperative bank, and you want to rejoin the board of that bank, then there is a 3 year of cooling off period that will be there. So mandatory 3 year cooling off period is imposed after the director has completed 10 years of the tenure if the director wants to join the same bank. This is the idea. Now, relief measures in areas affected by natural calamities. This we have just discussed in the May file. In the weekend marathon session also, I have discussed these natural calamities relief measures, review of lending norms for the urban cooperative banks. This also we have discussed. So these are the directions from May 2026 that you already or the April 2026 that we have already covered in the Finance 360 or in the marathon sessions, weekend marathon sessions and such. Chalo. Now, moving forward with the next one, that is FinTech department. So, RBI enhanced retail CBDC by introducing user level programmability. I hope you remember that in the retail central bank digital currency, there is the programmability feature. That means the central bank digital currency, let's say it is provided for the food subsidy, or let's say the government is providing the direct benefit transfer under the LPG cylinders, or the government is providing the direct benefit transfer under the fertilizer subsidy through the CBDC. So the users of these CBDC, um, or the subscribers basically that are using the CBDC can only use it for the particular case, for the food or for the LPG or for the fertilizers. Okay, so that is user level programmability. This will help in the direct benefit transfers for the money to flow in the right direction. Next is RBI expanded the offline CBDC pilots. Now for the offline CBDC, for the central bank digital currency to be used in the offline, means the near field communication technology like the tap facility and such, they are being checked, as well as the SMS based offline payments, they are also being seen, okay, for the offline CBDC to work. As well as there is the broadening of the wholesale CBDC. So wholesale CBDC is basically the CBDC that is used by the banks for their transactions, like the interbank transactions. Now the wholesale CBDC, its vision or its usage is being broadened for the government security settlement also, and interbank borrowing, and pursuing the bilateral and multilateral. There is also the RBI that is pursuing bilateral and multilateral cross-border CBDC arrangement. So basically, RBI has expanded offline CBDC pilots by testing a near field communication and SMS based offline payments. The RBI is also broadening the wholesale CBDC usage for government securities transactions or government securities settlement and the interbank borrowing, as well as RBI is also pursuing bilateral and multilateral cross border CBDC arrangement. The RBI has announced the launch of RBI CBDC's asset tokenization sandbox. So sandbox is basically a testing environment that is provided by the RBI under the regulatory framework of the RBI, okay, where the new financial services or the financial products can be tested. So that is a sandbox. Now RBI has said that RBI is going to launch the RBI CBDC and asset tokenization sandbox, where the innovations can be tested for the CBDC, for the central bank digital currency and the asset tokenization. The assets should be tokenized so that the token form of the assets are being present in the accounts of the investors, so that it is not very easy to steal the actual securities away, because the securities or the assets will be in the token form. Okay, so it has been said that the RBI is going to launch the RBI CBDC and asset tokenization sandbox, as well as there is the unified market interface that is also being launched during the Global FinTech Festival 2025. Unified market interface, and this we have already discussed in the last session also, that under this unified market interface, under this platform, the certificate of deposits, they are the first instrument to be issued in tokenized form and settled through the wholesale CBDC. So, under the UMI, under the Unified Market Interface, certificate of deposits were the first instrument to be issued in tokenized form and settled through wholesale CBDC. I hope you remember this. Next is Mule Hunter AI. This was quite in news in the last year, and basically the Mule accounts were being discussed. That these are the accounts through which, let's say, some politician, through the mule account, through some accounts of the subordinates, through the accounts of some local people, through the accounts of some people working under the politician. So through the mule accounts, the politician was making the black money as the white money, or was transferring the money through the mule accounts through the subordinate accounts or the accounts of the subordinate. So Mule Hunter AI is the RBI Innovation Hub's AI-based fraud detection solution. Now, under this solution, there is the probability score that is provided to each bank account, indicating its likelihood of being a mule, enabling the banks to undertake enhanced due diligence in case there is very high probability score for a bank account to be the mule bank account. It has been implemented. Now this particular Mule Hunter AI, it has been implemented in 26 banks, and implementation is underway in 4 more banks. Next is framework. Now free AI was again quite in use in the last year, as well as a question came in phase 1, a question came, descriptive question, and came in phase 2 also. So framework for responsible and ethical enablement of artificial intelligence, that is free AI report, was released last year. There were 7 sutras that were provided, 6 pillars, and 26 actionable recommendations were provided under this report. So 7 sutras: trust is the foundation, people first, innovation and innovation over restraint, fairness and equity, accountability, understandable by design, safety, resilience, and sustainability. So these were the 7 sutras, and these are the 6 strategy pillars. So 7 sutras, 6 strategy pillars. That is infrastructure, policy, capacity, governance, protection, and assurance. And under the 6 strategy pillars, there are 26 actionable recommendations. Okay. Now, coming to the next one, that is the major initiatives under the FinTech department. So, fourth edition of Harbinger, the theme. So, fourth edition of Harbinger, this was again in news recently because the results were released for the fourth edition of Harbinger. The theme is securing secure banking, powered by identity, integrity, and inclusivity. And under the theme, under the fourth edition of Harbinger, how many problem statements were provided? Anyone remembers? So, the fourth edition of Harbinger, the theme is secure banking powered by identity, integrity, and inclusivity. Under the fourth edition of Harbinger, how many problem statements? 3 problem statements: tokenized KYC, offline CBDC, and enhancing trust. Okay. Next is RBI's regulatory sandbox framework, in which the different new financial products or the financial services can be tested. So, RBI's regulatory sandbox framework was operational since 2019, has completed 5 cohorts under the different themes, and expanded its on tap facility to accept theme neutral. So, the theme neutral was the last cohort under the RBI sandbox. So, the theme neutral was the last cohort under the RBI's sandbox, and it was said that the theme neutral, for that, on tap facility has been started. On tap facility is the facility where you can join the sandbox at any point of time. Okay, there is no set period in which you can join the cohort. You can join the cohort whenever you want. So this is the idea, that for theme neutral, on tap facility has been provided. Next is account aggregator framework. Account aggregators are basically the NBFCs that take the consent of the customer and transfer the information of the customer to the banks or to the entities. Okay, customer wants to take a loan, so the customer has to transfer the information to the bank. The account aggregator, being the intermediaries, they can easily collect the information about the customers through different methods, like from the banks, from the NBFCs, from the asset management companies, the from the GST, from the GSTN, or from the income tax department. The information can be collected about the customer, and that can be provided to the information user. So there are the financial information providers, from which the information is collected by the account aggregator to provide it to financial information users. Now, the RBI has upgraded the account aggregator framework through Financial Information Schema version 2.0 by expanding the scope of the financial information that can be provided to the financial information users, with addition of new fields such as the account type, currency, the central KYC registration status, and such. So basically, there is the account aggregator framework that has been upgraded through Financial Information Schema version 2.0, so that more information can be transferred to the financial information users with the consent of the customer. Fintech department continued regular engagement with the fintech ecosystem. So there are 2 initiatives of the fintech department. One is Fintract, and the other is Finquiry. Under the Fintract sessions, these are conducted across various cities to connect with the fintech companies, while the Finquiry provides a forum at the fintech department, Reserve Bank of India, Mumbai, for fintechs to seek clarity and discuss any matter of relevance. So there is Finquery and there is Fintract, that you have to remember, and usage of both of them. Now, RBI set up RBI Innovation Pavilion during the 6th edition of the Global FinTech Festival 2025, as well as a Reserve Bank, in collaboration with Reserve Bank Innovation Hub, organized the FinTech Showcase. The Central Bankers Roundtable was also convened on the theme Harnessing Emerging Tech in Finance, in which the BIS, that is Bank for International Settlement, Innovation Hub, Singapore, European Central Banks, and multiple other central banks were present. Next is the projects undertaken through Reserve Bank Innovation Hub. So the projects that have been undertaken by the Reserve Bank Innovation Hub is Mule Hunter AI Unified Lending Interface, Digital Payment Intelligence Platform. The RBIH also operates fintech and emerging technologies repository. So remember that the Mule Hunter AI is the project undertaken through the RBIH, Unified Lending Interface, the Digital Payment Intelligence Platform. All of these are the initiatives under the Reserve Bank Innovation Hub, and Reserve Bank Innovation Hub is the one that is operating fintech and emerging technologies. Got it? Chalo. Next is Singapore FinTech Festival. So, Singapore FinTech Festival is a flagship global fintech event organized with the support of the Monetary Authority of Singapore, Global Finance and Technology Network, and other partners. Now, Reserve Bank of India, in collaboration with the other regulators of our country, they joined the Singapore FinTech Festival, the 10th edition of the Singapore FinTech Festival. Now, coming to the next part. Any confusion? Now, coming to the fraud analysis and such. So, first, cyber risk. Under the Department of Supervision, the Department of Supervision focuses on cyber risk. In order to enhance cyber resilience across the supervised entities, the Reserve Bank has operationalized the Cyber Range Initiative through a state-of-the-art platform deployed at Institute for Development and Research in Banking Technology. So basically, the Reserve Bank of India has operationalized the Cyber Range Initiative through the best-in-class platform, through the state-of-the-art platform deployed at what? Deployed at Institute for Development and Research in Banking Technology. Okay. Now coming to the next part, the data you don't have to remember. What you have to remember is that as per the assessment of the bank group wise fraud cases over the last 3 years, this indicates that although the number of frauds for public and private sector banks have reduced, so here you can see that the number of frauds have reduced for the public sector banks and for the private sector banks. Okay? The number of frauds have reduced. The number of frauds 7,000, 6,000, now 5,418. So number of frauds have reduced for the public sector banks, for the private sector banks also 23,000, 14,000, now 3,000. So you can see that number of frauds have reduced by a lot, from 7,000, from 23,000 to 5,000, 3,000 only. But the amount involved in the frauds, so number of frauds have decreased for public sector banks, for private sector banks, but the amount involved has increased over the years. The amount involved has massively increased over the years. This is the idea that you need to have. Next is, while the number of frauds was highest, see the number of frauds was highest, or the percentage of frauds here you can see it is highest in the card, internet, digital payments for the financial year 2023, 24, 24, 25. But suddenly in the advances in 2025, 26, the number of frauds have increased in the advances category, in the loan category. Okay. So any confusion here? So basically card, internet, digital payments. So number of frauds were highest under the card, internet, digital payments category during the two previous financial years. But in the 2025-26, the number of frauds were highest in the advanced category. The value of frauds is always higher in the advanced category. The value of frauds is always highest in the advanced category. But now the number of frauds have also become highest in the advanced category. This is the idea. Next is thematic studies were conducted in the area. So thematic studies were conducted by the department under the Reserve Bank of India, because these are the areas which are the focus areas currently. Credit card operations, business correspondence, efficiency of the transaction monitoring system uh, in the major banks, where like relating to the KYC, anti-money laundering, countering the terrorist financing and such, top-up housing loans that we discussed for the urban cooperative banks and such, the implementation of internal ombudsman scheme and adoption of AI in supervised entities. So basically the studies were done on the themes, basically where we are focusing right now, or where the RBI is focusing: credit card, KYC, business correspondence, top up housing loans, the internal ombudsman scheme, and the adoption of AI. So these were the focus areas in 2025-26 in which the thematic studies happened. RBI has developed a separate supervisory rating model for the small finance banks. Okay, supervisory rating models basically show the rating of the small finance bank on the basis of the risk perceived of the small finance bank, on the basis of how risky the small finance bank is, as well as the framework for the supervisory rating is being reviewed for asset reconstruction companies, and it has been said that there is a need for development of supervisory rating model for the payment bank also. Okay, work the RBI is working, like there is a work under progress, the work is under progress on a service availability and resilience framework for digital banking channels, that how resilient they are, how much service availability they have, like how many of the services they are providing in a resilient manner. So the service availability and resilience framework for digital banking channels is under progress. A set of baseline requirements on digital forensic readiness. Digital forensic readiness, it shows the readiness of the digital channels. And currently, the online dashboard for real time monitoring of bank service availability across select digital services is currently being evaluated under a pilot phase through the Indian Banks Association, involving 10 banks, to see the service availability, the resilience of the digital banking channels and such. This is the idea. Any confusion? No need to remember the amount here, because there is too much data that you will have to focus on. The idea is that in 2025-26, the value, in terms of the value, the frauds were highest in which category? In the off balance sheet, forex transactions, card, internet, digital payments, deposits, or advances. So in the advances category, the value of the frauds were highest. The number of frauds, they were highest in the 2024-25. In which category? In 2024-25, they were highest in card, internet, and digital payments category, but in 2025-26, they are highest in advances category. To get the value of frauds. Now, coming to the next part, that is comprehensive review of RBA, that is risk based approach for KYC, anti-money laundering supervision of select UCBs was completed, with revised framework covering urban cooperative banks accounting for around 60% of total deposits. So comprehensive review was done. That's it. Now it has been said that supervisory data quality index. See, supervisory data quality index, it is a measure to assess the quality of data that is submitted by the reporting entities, by the regulated entities under the Reserve Bank of India. So supervisory data quality index, it sees the data, or it assess the data on four parameters: the accuracy of the data submitted by the regulated entities to the RBI, the completeness of the data, the timeliness, in the timely manner or not, and the consistency. Now, it has been said that the supervisory data quality index will be developed for the tier 3 and tier 4 UCBs also. The revised KYC anti money laundering supervisory framework for NBFCs increase the coverage of NBFCs, and the department uh, has initiated the process for development of risk-based supervisory framework for urban cooperative banks and select NBFCs. Next is rather in RBI enhance the liquidity stress testing rather than focusing on reverse stress testing approach. Now RBI has said that we will be focusing on forward-looking model. Okay, so rather than reverse stress testing approach, we will be looking forward with the forward-looking model. Next is the high-level bilateral exchanges were undertaken with Central Bank of Russia and Monetary Authority of Singapore for supervisory cooperation, exchange of the best practices and such. This is it. During the year thematic studies, so now under this Department of Supervision, so there were the thematic studies in the areas of cyber risk that were also carried out. The cyber mapping exercise was undertaken with the objective of evaluating the cyber risk exposure and interdependencies across commercial banks and such. So cyber risk mapping also happened, or cyber mapping happened, so that the risk can be identified and such. This is it. Next is publication of Supervisory Data Quality Index from June 2025. It was decided that the Supervisory Data Quality Index will be released on the quarterly basis. Coming to the last part now. Till now, any confusion? So here, but you have to remember that the comprehensive review happened of the risk-based approach for the UCBs, covering UCBs accounting for 60% of the total deposits. And rather than focusing on the reverse stress testing approach, now the RBI will be focusing on the forward-looking model for the liquidity stress testing. The high-level bilateral exchanges happened with the Central Bank of Russia and Monetary Authority of Singapore, as well as the Supervisory Data Quality Index. Now, from June 2025, it was released on the quarterly basis. There were thematic studies that were done on the cyber risk, and cyber mapping exercise were adopted. Next is that an enforcement department, it imposed penalties on multiple categories of banks, the highest number of penalties were imposed on the public sector banks, and the highest amount of penalty cumulatively was also imposed on the public sector banks. That is the idea. Next is DICGC. DICGC is the Deposit Insurance and Credit Guarantee Corporation. So number of registered insured banks for which the deposits are insured by the DICGC stood at 1950. What is the amount of insurance that is provided by the DICGC for each depositor in the insured banks? So the current coverage limit of deposit insurance is 5 lakh per depositor. 5 lakh per depositor. Now the number of fully insured deposit accounts, or basically the percentage you have to remember. So 97.5% of the total number of accounts, they are fully insured. They are fully insured, 97.5%. And the amount of the assessable deposits, the amount of the deposits of the depositor that is insured is 41.1%. So the number of fully insured accounts, or the percentage of the total number of accounts that is fully insured is 97.5%. Okay, that means the whole amount in these accounts is insured up to 5 lakh. The amount is in these accounts, and the percentage of the assessable deposits that are insured, it is 41.1%. That's it. Next is reserve ratio, that is how much the DICGC is maintaining in the deposit insurance fund. So DICGC is keeping the banks are getting the deposits, out of which they have to maintain the cash reserve ratio, that is the banks have to maintain the reserves, right? Similarly, DICGC also has the reserve ratio, that is the deposit insurance fund divided by the insured amount or insured deposits. So the ICGC is maintaining the reserve ratio of 2.37%. The ICGC is maintaining the reserve ratio of 2.37%. Currently, the coverage limit is 2.4 times the GDP per capita in 2025-26. Okay, so coverage limit is 2.4 times the GDP per capita. Now, next is deposit insurance premium. Growth happened 11.9%. So during 2025-26, the deposit insurance premium grew by 11.9%. That's it. Numbers are not important. Percentages are important. That too for 2025-26. The previous 2024-25 is not important. Now, coming to the next chapter. Now the chapters will be shorter. This was the lengthiest chapter. Coming to the next chapter. Any confusion till now? Next is auto bidding C, public debt management. So as you know that for the central government, state governments, for the central government, for the 28 state governments and 3 union territories, including the government of National Capital Territory of Delhi, it is the Reserve Bank of India who is responsible for public debt management. And Reserve Bank of India has a department, that is Internal Debt Management Department, who is responsible for the public debt management. So what are the updates? What is the change that has happened in 2025-26? So basically, auto bidding facility for the T-bills was introduced in the RBI Retail Direct platform, through which the retail investors can directly invest in the government securities. So there is the auto bidding facility that was provided especially for the treasury bills. Okay. Next important point is that the share of market borrowings in financing. So the state governments, they have the gross fiscal deficit, they have the fiscal deficit. That means they had the borrowing requirement. So 76.3%. Now, what is fiscal deficit that we have discussed yesterday? Fiscal deficit is the total expenditure minus the total receipts excluding borrowing. So fiscal deficit actually shows the borrowing requirement of the government. The borrowing requirement of the government. So the gross fiscal deficit out of the total borrowing requirement of the state government, 76.3% was met through the market borrowings. Okay? So out of the total borrowing requirement, out of the total fiscal deficit of the state governments of the states, the 76.3% was met through the through the market borrowing. 76.3% was met through the market borrowings. That's it. Next is some API has been developed so that if you want to transfer your government securities from the retail direct gilt accounts, so if you want to transfer your securities, government securities, let's say you are retail investor, if you want to transfer your government securities, that is in the demat form, if you want to transfer it from the retail direct gilt accounts you can transfer it to the demat accounts that are held with the CDSL or NSDL, that is the SEBI regulated depository. So it is allowed that free of cost you can transfer your government securities from your retail direct gilt account to the demat accounts. Next is gross market borrowings. So gross market borrowings for the central government from the dated government securities. Dated government securities, they are the long-term government securities, 10 years, 15 years and such. Okay? So gross market borrowings of the government of India, the total market borrowings of the government of India through the dated government securities were higher by 4.3% in the 2025-26. That's it. So gross market borrowings increased by 4.3% for the central government through the dated government securities. Net market borrowings. Now, net market borrowings is what anyone knows. Net market borrowings are the gross borrowings minus the repayment that has happened. So gross borrowings are, let's say, 100 crores. Repayment is 20 crores. So net market borrowings will be 80 crores only. Okay? So net market borrowings are taken into account when the gross market borrowings minus repayment. Okay? So gross market borrowings through the dated government security increased by 4.3%, but net market borrowings were lower by 2.6% because of the higher repayments, as well as the net market borrowings. So net market borrowings were lower by 2.6%. This is for the dated government securities. The gross market borrowings were higher by 4.3% for the dated government securities. Now, with the dated government securities, that are the long-term government securities plus the treasury bills, for them, the net market borrowings were higher by 0.2%. By 0.2%. So net market borrowings through dated government securities and the T-bills, the net market borrowing was higher by 0.2%. That is the idea. I hope this is clear. 4.3%, 2.6%, and 0.2%. Now, treasury bills. The number you do not have to remember, but here the treasury bills, they are for the short term. They are only for 14 days or 91 days, 182 days, and such. So treasury bills, that means within the year they are being borrowed, the money is being borrowed and it is being repaid. From the last year also, let's say there are some government securities that were given in the last period, let's say on 31st March 2025. Now from 1st April 2025, the new financial year 2025-26 is starting. So for that also the repayments happen in the financial year 2025-26. So basically, the treasury bills had the net short-term issuance of 48,672 crore negative. That means there were more repayments that happened than the borrowings. Okay? Because the repayments had to happen for the previous treasury bills also for the past year. So this is the idea, and basically the net short-term issuance of the T-bills were still higher than the previous year, because in the previous year the negative was larger. In 2024-25, the negative was larger in comparison to 2025-26. Okay, this is the idea. So the numbers you don't have to remember, just the idea I wanted to provide you, that in the T-bills the net short-term issuances is in negative, because in the same year uh, the repayment has to happen, or the repayment has to happen for the previous years also. Now, ownership of securities, this is very, very important. The most important part in this whole chapter, of public debt management, this is very important, that the ownership of securities, the government securities, the ownership is the highest in the hands of the commercial banks. Commercial banks remain the largest holder of government securities, including the T-bills, including the central state government securities, accounting for 34.6%. Numbers are not important here. Next, after the commercial banks, insurance companies, then the provident funds, then the reserve bank, and the share of foreign portfolio investors was only 1.8% in the ownership of government securities. So the ownership of securities the highest in the hands of the commercial banks, then the insurance companies, then the provident funds, then the reserve bank, and the least least is not given. Next is short term yields. So for the short term, the yields, the short term interest rate for the government securities, it softened. That means it decreased. Why it decreased? Because the repo rate is decreasing in the economy. The RBI decreased the repo rate from 6.50% to 5.25%. So RBI decreased the repo rate, and with the decrease in the repo rate, there was the decrease in the interest rate for the government securities. The short term yield decreased because of the monetary policy easing, because of the liquidity injection the RBI was providing the liquidity in the economy, as well as the sovereign credit rating upgrade. The government securities credit rating upgraded, due to which also lesser interest was given. But the medium term, because of the volatility in the global market, because of the West Asia crisis, the medium term and the long term yields have hardened by, let's say, 49 basis point for the 10-year. For the long term, for the medium term, the interest rate is increasing basically because of the geopolitical risk. Short term yields softened, the interest rate decreased, but for the medium term and long term, the yields or interest rate is increasing. Now next is, during 2025-26, about 50.9% of the market borrowing under the was raised through the issuance of dated government securities of 10 years and above. So about like more than half, more than 50% of the market borrowing was through the dated government security of 10-year and above. And in this 10-year and above, the maximum portion was of 15-year and above, which constituted for 33.5%. So 15 years and above, contribution was 33.5% of the market borrowing. So highest market borrowing is through the 15 years and above. You can understand. This is the idea. Next is, the number of primary dealers stood at 21. These are the primary dealers. They are the market makers that help in the buying and selling of the government securities. And the share of amount allotted to primary dealers in the auction of T-bills increased to 76.1%. So 76.1% of the T-bills, it was provided to the primary dealers. Next is 2025-26, the 27 states and 2 union territories issued dated securities of tenures other than 10 years, ranging from 2 years to 38 years, due to which the RBI said that the benchmark issuance strategy will be adopted, so that the state governments, they do not release the securities for the different tenures. The tenure should be decided 3 years, 5 years, 10 years, and 15 years in this manner, because the state government securities, they were releasing the dated government securities for varying tenures. That was very confusing. Now, coming to the next chapter, any confusion in the previous chapter? Now, currency management. Coming to the next chapter, that is currency management. We have discussed about the uh, public public debt management. It is a very lengthy chapter, but I have provided you the most important points that you can keep in mind. In that also, I have told you that ownership of securities is very, very important. Okay. Chalo. Now coming to the next one, currency management. So value and volume of the banknotes in circulation has increased. The value has increased by 11.9% and the volume has increased by 10.5%. In volume terms, 500 denomination. This is important. In volume terms, number of notes basically. The volume terms, 500 denomination constituted the highest share of the total banknotes. And after the 500, the second highest were rupees 10 in the volume terms. The withdrawal of 2000 banknotes from circulation. So it was announced in May 2023 that there is the withdrawal of 2000 banknotes, and till now, till March 31st, 2026, till March 31st, 2026, till the end of the 2025-26 financial year, 98.45% of the 3.56 lakh crore of 2000 banknotes, they have been withdrawn. So basically 98.45%, 98% of the notes have been withdrawn. That is the idea. 98% of the value of the 98% of the value of the 2000 banknotes, they have been withdrawn. This is the idea. Next, so what is the highest currency in circulation in terms of volume? What is the highest denomination of currency? Denomination of currency that is in circulation. Is it 100 rupees, 10 rupees, 20, 30, 20, 50? So it is 500. Okay? Or 500. Now, in the terms of coins, see the total value as well as volume of coins in circulation increased by 11.4% in value and 4.5% in volume. As on March 31st, 2026, the coins of 1 rupee, 2 rupee, 5 rupee together constituted 80.7% in volume, as well as these coins constituted the highest in value also. E-rupee in circulation, not very important. The upgradation of banknote processing infrastructure at Reserve Bank's issue offices. So RBI has 19 issue offices. So the upgradation of banknote processing infrastructure is happening at the Reserve Bank's issue offices through the different machines, through the different technology, through the different systems that you can read. Next, now coming to the next part. So basically, as I've told you, RBI has 19 issue offices and the currency chest. the State Bank of India has the highest number of currency chest, as well as the State Bank of India is also having the highest number of small coin depots. Okay. So that is the currency chest. They are connected with the Reserve Bank of India, so that through these currency chests the money can be provided to the bank branches and such. So the State Bank of India is the largest provider of the currency chest. Okay. Next is awareness campaign on misinformation on coins. See, recently, in like a few months before, you must have heard that 10 rupee coins are fake, or 20 rupee coins, if they are coming in the market, they are fake. Many of the people, they were not accepting 20 rupee coins because they were afraid that it is fake, or the 10 rupees coins were not being accepted. So RBI ran the awareness campaigns on misinformation on the coins. So sustained awareness campaigns were run through print, digital and social media to dispel the misinformation on the coins, resulted in substantial increase in the acceptance of coins amongst public. There is also mobile aided note identifier, that is money, and exchange facility for soiled banknotes is also provided, so that you can exchange your soiled notes. Next is the during 2025-26, out of the total fake Indian currency notes detected in the banking sector, 2.4% was detected in the detected at the Reserve Bank. Counterfeit notes detected in the denomination of 10, 50, 100 and 20, 200 and sorry. 10, 50, 100, 200 and 2000 declined. The counterfeit notes detected in the denomination of 10, 50, 100, 200 and 2000 have declined, while there is the increase of the counterfeit notes in the denomination of 20 and 500. And the 500 denomination, like the 20 denomination, counterfeit notes increases higher. Indian currency microsite, where the currency related information is provided to the public, was launched in September 2025, replacing the earlier Paisa Bolta Hai. Okay. Next is three services pertaining to exchange of notes. They are under the ambit of Citizen Charter. So Citizen Charter, this is basically providing for, or this is basically informing different services that the RBI different departments are providing. Okay, so three services pertaining to the exchange of notes, they have been brought under the ambit of Citizen Charter. Postal, like the exchange of notes received through the postal covers, through the triple lock boxes from the banks, from the currency chest, and the notes that cannot withstand normal handling. So three service pertaining to the exchange of notes, they have come under the ambit of the Citizen Charter. Basically, it informs about the service that the RBI departments are providing. Next is Bharatiya Reserve Bank Note Mudran Private Limited. This has been playing a critical role in designing, printing, supply of banknotes during the year print trials of varnish notes. Varnish notes, basically, they have some kind of varnishing, or they have some kind of covering, so that they do not get soiled very fast. Okay. So print trials of varnish notes were conducted at the Mysuru printing press of the BRBN MPL. So this is the idea. Now this chapter is also done. Any confusion? Here, what you have to remember is basically the value and volume. The volume terms 500 denomination is highest than 10 rupee notes. Then you can read about the coins. So this is the idea. Now coming to the next chapter, that is payment. And see, if you want to know more about the currencies, you can go to Indian currency microsite. Next is payment and settlement systems and information technology. Coming to the ninth chapter, just two more chapters left. Very, like, we will be able to do it in a fast manner. So Reserve Bank released Payment Vision 2028. Do you remember the Payment Vision 2028? We have discussed it in detail. So RBI has released the Payment Vision 2028 during the year, outlining the roadmap for the digital payments up to December 2028. Department of Payment and Settlement System undertook several initiatives in line with the Payment Vision. So in 2025, now the Payment Vision 2028 has been released for the financial year from 2026, right? From the 2026. Now, for 2025-26, that is for the previous financial year, the Department of Payment and Settlement System was undertaking several initiatives in line with the previous payment vision, that was the Payment Vision 2025, across the pillars: integrity, inclusion, internationalization, institutionalization, and innovation. So, the five pillars under the Payment Vision 2025 are integrity, inclusion, innovation, institutionalization, and internalization. Okay? and the DPSS was taking several initiatives in line to this. Now, cashless transactions recorded a robust growth of 26.8% in terms of volume, while in terms of value, the cashless transactions have increased by 13.2%. During 2025-26, the transactions processed through the real-time gross settlement, that is considered the large value credit transfer. So the volume through RTGS transactions increased by 15.7%, while the value increased by 12.9%. The rest comes under the retail payments, that is the credit transfers, the debit transfers, card payments, prepaid payment instruments. These come under the retail payment transactions. These come under the retail payment transactions. Recorded an increase of 26.8% in volume and 14% in value. UPI continued. Now, in this, the most important point is this: UPI continued to account for the largest share in retail payments. In retail payments, UPI has the largest share. So, in the retail segment, in the retail payments, UPI has the largest largest share, contributing nearly 86% of the total retail payment transactions. So, out of the total retail payment transaction, 86% is the share of the UPI. During the year 2025-26. UPI transactions increased by 30% in volume terms and 20.6% in value terms. Okay? The Reserve Bank conducted a survey also of 30,000 customers and 10,000 merchants, in which it was identified that 52% of the users have adopted digital payments because of the ease and speed and convenience. 67% of the merchants reported accepting digital payment modes because of the ease and convenience and because of their business activities. Now, next is major developments done by the Department of Payment and Settlement System. So, basically, due diligence of Aadhaar enabled payment system touchpoint operators, it was said that the Aadhaar enabled payment system touchpoint operators, see, Aadhaar enabled payment system, basically you provide your Aadhaar details, you provide your biometric, and you are able to do the transfer of money, you are able to do the transaction, you are able to get the mini statement and such. So, Aadhaar enabled payment system touchpoint operators are the business correspondents, agents of the banks, or they are the touchpoint operators authorized to have the Aadhaar enabled payment system or to operate the Aadhaar enabled payment system, to work on that. So they have that machine where they can take the thumbprint or iris scan and they can take the Aadhaar details so that the transaction can be done for the customer. Now, it was said that the due diligence should be done for Aadhaar enabled payment system touchpoint operators. So within 3 months, I think it was said that if the Aadhaar enabled payment system touchpoint operator is basically not doing the transactions in the previous period, so in like previous 3 months and such, so again the due diligence should happen. Master direction on regulation of payment aggregator for the payment aggregators. There was the master direction that was released for the payment aggregator online, offline, physical, and such, or the cross border online, offline, that is physical mode, and for the payment aggregator cross border, there were the regulations that were released last year. Directions on framework on authentication mechanism, basically it was said that the people have or the merchants, sorry, there are various issuers, banks and such, they are depending on the OTP. Now, the directions were released that there is the need to find other authentication mechanism for the digital payment transactions. We should not only depend on OTP. So, encourage the adoption of new authentication factors. Then, continuous clearing and settlement on realization in the check truncation system. So, in the check truncation system for the check clearing, usually the time was taken that today the check will come, by tomorrow it will be tomorrow the settlement will happen. So now it has been said that rather than T plus 1 days, now within few hours your check will be cleared if the timelines are being followed. Formation of payment regulatory board. So it was basically said that the board for a payment and settlement system, board for regulation of payment and settlement system, it will be replaced by the payment regulatory board. And recently the first meeting happened in January 2026. I will suggest you that at least go through the payment regulatory board and the first meeting, the members. Okay. Digital payment index, basically here you can see that digital payment index, the value increased, the digital payment index value increased from March 2025 to September 2025. And basically digital payment index, it shows the increase in the digital payments on the basis of five parameters. On the basis of five parameters. Okay? Payment enablers, payment infrastructure supply side, payment infrastructure demand side, payment performance, and consumer centricity. Now, digital payment index, I think I remember that the digital payment index increased because of two factors. That was the payment performance or and the payment enablers. Just I have taught this. So if you want to check it, do check it once. But what I remember is that the digital payment index increased from March to September because of the payment performance and payment enablers. I this is this anyone who remembers this? Now next is global outreach of payment systems. Do check it once also. Okay. Global outreach of payment system, the fast payment system bilateral linking of India's UPI with Singapore's Pay Now. Yes. So fast payment system. So basically, the India's UPI was connected with the Singapore's Pay Now. Okay. As well as the RBI has also joined Project Nexus, that is under the BIS Innovation Hub, as well as the acceptance of UPI for QR code based merchants is operational in Bhutan, France, Mauritius, Nepal, Qatar, Singapore, Sri Lanka, and UAE. Deployment work of UPI like infrastructure is ongoing in Namibia and Peru, as well as RuPay. Like this RuPay is the indigenous card network. So the Rupee Stack deployment and development of domestic card scheme has been completed in Mauritius and the UAE. Now, coming to the next part, that is the Department of Information Technology. So, the department's initiative. So, we have discussed about the initiatives by the Department of Payment and Settlement System. Now, Department of Information Technology, it introduced an exclusive .bank.in domain. I hope you remember this, that this is for the website of the banks so that the banks can be easily recognized. So departments Department of Information Technology initiative was to introduce an exclusive .bank.in domain, marked India as the first country globally to mandate a secure domain for the banking system, thereby strengthening the cyber security and such. By March 2026, all bank categories had migrated their corporate website to .bank.in domain. Other than remaining foreign banks and cooperative banks, all the other bank categories like the scheduled commercial bank, the private banks, public sector banks, as well as the small finance bank, they all have migrated to the .bank.in domain. This effort was recognized by the Central Banking London, which honored the Reserve Bank with the Initiative of the Year 2026 award, as the Department of Information Technology took the initiative of the .bank.in domain. Next is implementation status. So the Department of Information Technology has also taken other initiatives which are in the implementing stage, or the implementation status is that for the India Financial Sector Cloud, or the indigenous India Financial Sector Cloud. This is in the beta phase. This was made live during the year, and the 9 entities have been onboarded in this beta phase. Development of Development of Center for Financial Literacy module was completed during the year. Development of the Global Structured Financing Messaging System Hub. This is important. There is the development that is happening of the Global Structured Financing Messaging System Hub. So till now, what is the like till now there is the international platform that we use, or the international messaging system that we use for the cross border transfer of messages. Let's say the Bank of India is doing the transaction with the Bank of US, so the messages will be sent through the international system. Now the India, or the bank for the Department of Information Technology under the Reserve Bank of India, is developing the global structured financial messaging system, that is SFMS hub for cross-border messaging. Okay, so there is the development of the global structured financial messaging system hub for cross-border messaging. This has been completed. So the development of the SFMS hub has been completed. The development of the domestic messaging system is also underway, so that the banks will able to communicate very easily then in the domestic territory. The said system would be based on the globally accepted ISO 20022 messaging standard, and include all the functionalities offered by the existing centralized payment system in the domestic territory, along with the other advanced functionalities. Okay. Now, major initiatives. So, as part of its ongoing efforts to modernize payment infrastructure, the Reserve Bank upgraded next generation real time gross settlement from version 3.0 to 4.0. Reserve Bank's NEFT system has been ISO compliant since 2023, but the banks were not. So the banks, 230 member banks they were migrating through a converter solution, or they were connecting to the NEFT system through the converter solution. Now, during the year, all the member banks have completed the migration of their core banking solution or middleware to ISO messaging standard, and that's why they will be able to directly transmit to the NEFT system without the converters. The construction of the second greenfield data center and enterprise computing and cyber security training institute has been completed and all statutory approvals are in place. Okay, so these are the major initiatives that have been taken. Now previously check inward clearing and the centralized inward clearing, this was done or handled by 19 regional offices. So previously the check inward clearing and the centralized inward clearing, they were being handled by the regional offices, but now it has been said that there is the establishment of a service branch at Chennai regional office, so it will handle the uh, inward clearing operations. Okay, this is the idea. Next is operationalization of the global SFMS hub. So we have discussed that the global SFMS hub, it has been developed in India by the Department of Information Technology, and this particular hub, this will facilitate the cross border. This will facilitate the cross-border messaging system. This is basically the cross-border messaging system built on the globally accepted ISO 20022 standards, and bilateral collaborations have, they are underway for the global SFMS, because if we develop a system but it is not used at the international level, then there is no benefit of developing the system. At least some countries should use it, right? So bilateral collaborations are underway with the UAE for interlinking their financial messaging system with the global SFMS hub. Now coming to the Rebit and IFTAS, this will be the last part for this particular chapter. So Rebit, this is the Reserve Bank Innovation Technology Private Limited. So it basically focuses on information technology. This is a wholly owned subsidiary of the Reserve Bank of India. Major projects undertaken by the Rebit during the year include upgradations to the Prava portal, Samanvay, that is a meeting management solution under the lead bank scheme, DICGC website with an AI-enabled FAQ chatbot. These were the upgrades done by the Rebit. Rebit strengthened the RBI cybersecurity infrastructure, as well as Rebit is assisting RBI in supervising regulated entities, facilitating IT and thematic examination, quick cybersecurity spot assessments of the regulated entities. So Rebit is strengthening RBI cybersecurity infrastructure, as well as Rebit is assisting RBI in supervising the regulated entities, facilitating IT and thematic examination, quick cybersecurity spot assessment, and such. As part of the next year's agenda, Rebit will support Department of Information Technology in operationalizing the next generation core banking solution, eKuber 3.0. Yes, Swift is there, but that is the international messaging system. Now India is developing its own. Okay. Indian Financial Technology and Allied Services, IFTAS commenced development. Now there is Rebit as well as IFTAS. IFTAS is for the Financial Technology and Allied Services. So IFTAS, it is the Indian Financial Technology and Allied Services. It is the wholly owned subsidiary of the Reserve Bank of India. It has commenced development of the alternate payment system integrating NEFT, RTGS, FFM, FMS, FM, FSFMS. I don't know what happens to me when it comes to short forms. So, IFTAS commence development of the alternate payment system integrating NEFT, RTGS, SFMS, which is currently undergoing functional and performance testing. Okay? So, SFMS, this is going to be the global messaging system that is developed by India. Not only the global, but the domestic SFMS is also being developed for the domestic communication. IFTAS developed global SFMS hub, which is presently in closed user group testing with member banks and designated central bank of the other countries as technology partner for CCIL IFSC Limited. IFTAS. So IFSC is the International Financial Service Center that is present in the Gift City in Gujarat. So the IFTAS is the technology partner for the CCIL IFSC Limited. So IFTAS has launched the foreign currency settlement system in October 2025, so that the near real time foreign currency settlement can happen in GIFT IFSC. IFTAS was entrusted with the building of the Indian financial sector cloud also. During the year, Reserve Bank through IFTAS successfully executed the transition from Infinet 2.0 to 3.0 and Internet 1.0 to 2.0. As well as there is the overall service delivery using software defined wide area network technology that was also done. Now coming to the 10th chapter, you can understand that this is going to be the last chapter, because after this there is nothing that we have to discuss. So let's start with this chapter: communication, international relations, and research and statistics. So basically we are going to start with the communication processes. Any confusion in the previous chapter? Any confusion, anyone? Communication processes, Department of Communication. So during 2025-26, Department of Communication implemented Communication Policy 3.0, retaining its focus on agility, accuracy, and accessibility of information. So basically, RBI is a very transparent organization. It keeps on having multiple interactions with the public, or through its press releases. It keeps on informing the public about the changes that is happening. Okay, so through its media interactions or through its press releases, it keeps on informing the public. Now, basically, the Reserve Bank has launched its official podcast series, that is RBI Talks from Paisa to Policy. And the first podcast was titled Demystifying the Know Your Customer. Under the overarching theme of RBI कहता है जानकार बनिए सतर्क रहिए, the Reserve Bank undertakes comprehensive multilingual public awareness campaigns to familiarize the public with key regulatory messages and build financial awareness. Further simplified public awareness messages with the tagline RBI कहता है smart बनो cool रहो. So such kind of tagline, such kind of question can come that what was the first what was the theme of the first episode of the RBI podcast, okay? Or what is the overarching theme of the Reserve Bank of India in case it is running the multilingual public awareness campaign. So RBI कहता है जानकार बनिए सतर्क रहिए and such. Next is during 2025-26, the Department of Communication disseminated customized communication using various media in 11 major regional languages apart from Hindi and English. Next is social media. The RBI is quite like RBI is active in the different social media through RBI and RBI Says platform. So in the X and LinkedIn and such. Next is the media interaction and workshops. As I've told you, that RBI also conducts media interaction so that the public can be made aware about the recent steps of RBI. The Reserve Bank conducted 6 media interactions in an informal Chatham House set up in Mumbai and Delhi, as well as 4 workshops were conducted in Vijayawada, Bhubaneswar, Nagpur, and Jaipur. International relations. Now coming to the international relations. India assumed the BRICS chair. So that is very important, that India took the BRICS chair. India became the BRICS chairperson. BRICS is the Brazil, Russia, India, China, South Africa plus now, because there are more countries that have joined. Okay? So India assumed the BRICS chair in 2026, guided by the theme Building for Resilience, Innovation, Cooperation and Sustainability. This was the theme, remember it. Building for Resilience, Innovation, Cooperation and Sustainability. RBI co-chaired the first BRICS Finance and Central Bank Deputies meeting. RBI also initiated discussions on the process of onboarding, because the new BRICS members are there, new members have joined BRICS, so they have to be onboarded into the contingent risk arrangement. Contingent risk reserve arrangement. Basically, only the BRICS members can use this. The BRICS member, they contribute in this arrangement, and when the BRICS member is in the balance of payment crisis, they are in the crisis situation, then the BRICS members only they can use the funds from the contingent reserve arrangement. Okay? So basically, Reserve Bank initiated discussions on the process of onboarding the new BRICS members into the CRA. MOUs, the Reserve Bank of India has done the MOUs with the Banque de France and European Central Bank. These MOUs were signed in March 2026, May 2026, respectively. The terms of engagement with Bank of Japan were renewed for 1 year. Next is CSEN. Under the international department, the South Asian Sea. CSEN, this is the Southeast Asian Central Bank's Research and Training Center. So CSEN, that is Southeast Asian Central Bank's Research and Training Center, comprising 19. So CSEN, Research and Training Center comprising 19 central banks and monetary authorities, remains Asia's premier capacity building hub. So CSEN is Asia's premier capacity building hub. Now the department, that is the international department of the Reserve Bank of India, actively engaged with CSEN, participating in the 24th meeting of the CSEN Executive Committee in Seoul, Korea, 45th CSEN Board of Governors meeting that was in Bali, Indonesia, and a special EXCO meeting that was in Kuala Lumpur, Malaysia. Now, you don't have to remember this, just remember the full form of CSEN, because CSEN, again, in the next slide also, you will see a important point about CSEN. So, CSEN is the Southeast Asia Central Banks Research and Training Center. ठीक है? Now, coming to the next, the Reserve Bank supported capacity building for central banks through SHARC. SHARC is basically South Asian Association Regional Cooperation. So, SHARC Finance is a network of central bank governors of and finance secretaries of SHARC countries. Okay? So, SHARC Finance, this is a network of central bank governors and finance secretaries of SHARC countries, that is South Asian Association Regional Cooperation. So, the Reserve Bank supported capacity building for central banks through SHARC, finance scholarship, field visits, technical assistance, and such. This is it. Any confusion, anyone? See, CSEN is basically the South East Asian Central Banks. This is a center. This is a center for research and training. For the research and training for the central banks. Okay. So this is the Southeast Asian Central Bank's Research and Training Center, basically. So CSEN is the research and training center for the central banks in the Asia Pacific region. Chalo. Now, coming to the next part, that is G20. South Africa, now this is important. South Africa assumed the G20 presidency in December 2024, okay, with the overarching theme of solidarity, equality, and sustainability. Now, South African presidency has ended with the leaders summit that happened in November 2025, and the US assumed the G20 presidency from December 1, 2025. See, whatever is marked or highlighted, that is the most important points that you have to keep in mind. The rest is also important from the descriptive point of view or from the phase 2 point of view. So right now, focus on the highlighted part more. Just read it and focus on the highlighted part more. The department hosted, that is international department hosted the 7th senior level dialogue between Reserve Bank of India and the Bank of Japan in Mumbai. Ninth meeting of the joint technical coordination committee with Nepal Rashtra Bank in November 2025 was also conducted by the international department. Next is government and bank accounts. So the Reserve Bank of India also has a department of government and bank accounts. So this department basically handles the bank accounts of the government, or it basically handles the transfer. So Department of Government and Bank Accounts in coordination with CSEN Center, that is Southeast Asian Central Banks Center. Okay, so CSEN. So basically, DGBA, that is Department of Government and Bank Accounts, in coordination with CSEN Center, organized first of its kind international conference on central bank accounting practices. This is the idea. Okay. So that's why I was saying that this season you will hear again. This is like the DGBA in coordination with CSEN have organized first of its kind international conference on central bank accounting practices. Next is implementation status. So during the year, 26 states and 3 union territories have gone live for Aadhaar based direct benefit transfer payments under the centrally sponsored schemes during the year centrally sponsored scheme. So this is written in very small because you just have to read it, do not have to focus on it much. The idea is that during the year the centrally sponsored schemes payment using NEFT RTGS payment mode was implemented for state government of Nagaland, union territories of Puducherry and Jammu, and the government of the national capital territory of Delhi that has recently been under the RBI and such. Okay. So during the year, the centrally sponsored scheme payments using NEFT RTGS payment mode was implemented for the state government of Nagaland, Union Territory of Puducherry and Jammu, and government of the NCT of Delhi. Next is, with this, all the 28 state governments and 3 union territories are live in centrally sponsored schemes. uh, State governments of Mizoram, Nagaland, Meghalaya, and City of New Delhi were onboarded for processing of online memorandum of error related to GST receipts. So basically, there are different state governments. State government of Nagaland, Meghalaya, and City of New Delhi and Mizoram, they were onboarded for processing of online memorandum of error related to GST receipts. So this is it. Agency commission rates, they were revised in April 2025. Agency commission, basically, I hope you remember that in the YouTube we have discussed that for the pension payments the agency commission is 80 rupees. For the physical payments, the agency commission for the agency banks is 40 rupees. For the e-receipts and such, there are the agency commission. Okay, so agency commission rates have been revised in April 2025. So the recent rates that you see are the rates that were revised in 2025. Further, it has been decided to review the agency commission rates once in every 3 years. Now, coming to the last part, recovery of excess pension paid to defense pensioners using direct NEFT RTGS receipt model was enabled during the year with the integration of e-Kuber and system for pension administration, Raksha, that is per system. So basically, if the recovery has to happen of the excess pension paid to the defense pensioners using direct NEFT RTGS receipt model, that can happen during like with the integration of e-Kuber and system for pension administration, Raksha. Next is managing of foreign exchange reserves. So Department of External Investments and Operations continued with the management of foreign exchange reserves. The foreign exchange reserve increased by 3.4% during 2025-26. Now, this department organized a focused discussion on bilateral swap lines, like we have the bilateral swap line with Japan, so that if India needs the dollars, we can provide our domestic currency and Japan can give us the dollars. We will return the dollars to them with some interest and they will return back our local currency. So, such bilateral swap lines. So, this department organized a focused discussion on the bilateral swap lines with central banks of ASEAN region. The department also conducted an international conference themed Resilient Reserves Anchoring Stability in an Era of Uncertainty. Now, the foreign exchange reserves, this is the era of uncertainty. Through this, you can remember this. Next is that, see, under different, after the Department of External Investments and Operations, there is DEPR, there is DISM, there is also statistics and some departments and such. So basically, these are the important points that I found. So this just you have to focus on. Amendments to the Banking Regulation Act 1949 and Reserve Bank of India Act. So amendments as per the amendments happened to the Banking Regulation Act 1949 and Reserve Bank of India Act 1934. It was said that the definition of fortnight was changed from reporting Friday to 15th of every month and the last day of every month. So before, the fortnight was taken as the reporting Friday. The fortnight, that is the 15-day time period, was taken as the reporting Friday, which was quite difficult to understand that which Friday. Now it has been said that the fortnight will be basically 15th of the month and the last day of the month. Okay? Centralized information management system analytical platform has been successfully upgraded to the Cloudera AI and internal testing is under process. That's it. Report on currency. Now this is a news because I was reading the document annual report and I went through it that the DEPR, I think under the DEPR it is written under the Department of Economic and Policy Research, the report on currency and finance titled India's External Sector Navigating Global Turbulence and the report on finances of Panchayati Raj institutions are being prepared. Next, coming to the 11th chapter. This is the last chapter and this is the last slide that we have to discuss. Then we can start with our MCQs. Chalo. So the good thing is that this is going to finish. Governance, human resources and organizational management, nothing much to discuss here. Utkarsh 2029 has been formulated. That is basically the medium term strategy framework for the Reserve Bank of India, on which I've taken a detailed session. Central government nominated Ms. Anuradha Thakur um, on the Central Board of Reserve Bank of India as the director on the Central Board of Reserve Bank of India, as well as under the Rajbhasha department. It has been said that we have to focus on the Hindi more. We have to focus more on Hindi, and there is the comprehensive action plan that is required to focus on Hindi more. There is a new magazine named Sanchayika that has been released. Okay, that's it. Now, so all the chapters are done. Part 1 was done in the previous session. We have discussed these chapters in the previous session. Now, the rest of the 6 chapters have been discussed in this particular session. Chalo. Any confusion? Now we will start with the MCQs. So we will do the MCQs in a rapid fire manner because in the previous session and in this particular session we have discussed the annual report. So I think the questions you will be able to answer now. Okay? Now, based on the global economic assessment and growth projections, consider the following statements. The global economy displayed a growth of 3.4% in 2025, recovering from a lower growth of 3.3% in 2024. Seems correct, right? the projected global economy expansion of 3.1% for 2026. So there is a projected global economic expansion of 3.1% for 2026. Absolutely correct. Global growth historical long-term average is 3.7%. So first statement is correct. Second statement is correct. Which of the following statements given above is or are incorrect? So third was incorrect, and that's why E is the answer here. Why? See, the question is incorrect, right? Don't make this kind of mistake, okay? First is correct, second is correct, third is wrong, and that's why the right answer is E here. Chalo. Moving forward, so this is the idea: 3.4% of growth in 2025, 3.3% of growth in 2024, 3.1% of growth in 2026. This is expected. Long-term growth projection is long-term growth average was 3.7%. Now, global inflation eased to 4.1% in 2025 from 5.8% in 2024, reflecting the impact of softening energy prices, normalization of supply chain constraints. Global inflation is projected higher at what percentage in 2026 than the earlier projection of 3.8% in January 2026. So I brought the questions from the most important points only. So here the projection is 4.4%. Very, very good. Yes, the projection is the global inflation is projected at 4.4% for 2026. Okay. So 4.1%, 4.1% in 2025 from 5.8% of 2024, 4.4% in 2026. Chalo. And the world goods and services trade volume grew by 5.1% in 2025. Now, on the demand side, private final consumption expenditure and fixed investment served as the key growth drivers, although the imposition of US tariffs initially triggered concerns. Their overall impact remained muted, with net exports exerting a modest drag of what percentage points on the growth. So, because of the US tariffs, the growth had a drag of what percentage point? 0.1%. Very good, very good. So see, you are able to remember many of the data points from the previous session also. So this is the idea. Now coming to the next one regarding the India. Now we have discussed about the global trends or the global data. Now coming to the India's data points. Okay, India's real GDP expanded at 7.6% during 2025-26. That was higher than 7.1% in 2024-25. Correct. India maintained its position as the fastest growing major economy, supported by strong domestic consumption, sustained investment, and proactive policy initiatives. Yes, correct. Real gross value added at basic prices expanded by 7.7% in 2025-26. This is also correct. So, which of the given statements above is or are correct? All of them are correct. All of them are correct. Okay. Real GVA. See, real GDP expanded at 7.6%. Real GVA at basic prices expanded at 7.7%. Okay. So both the like all the statements are correct. Real GDP expanded at 7.6%. Real GVA expanded by 7.7%. Remember this. Okay. Coming to the next question, try to read the question carefully and try to answer this question. According to the RBI Annual Report 2025-26, which of the following statements is incorrect? Headline inflation moderated to 2.1% in 2025-26 from 4.6%, largely driven by muted price pressure in food and favorable base effect. Yes. As per the second advanced estimate, the industrial sector recorded real GVA growth of 9.5% in the industrial sector, which was driven by a robust manufacturing sector. Yes, that is also correct. Manufacturing sector, I think, grew by 11.5% or 11.4%. Service sector continued to be the primary driver of aggregate supply, contributing to around 69% of the real GVA growth. This is also correct. Real GDP growth for 2026-27 is projected at what percentage? This is wrong. The real GDP growth for 2026-27 is projected at what percentage? This is wrong. The CPI inflation for 2026-27 is projected at 4.6%. This is correct. So D is incorrect because the real GDP growth for 2026-27 is projected at 6.9%. Okay. Now, yes, it is projected at 6.9%. Chalo. Coming to the next question, India has been ranked dash for AI competitiveness and ecosystem vibrancy. I have told you that AI is very important, and in the RBI Annual Report, the rankings were provided. So India has been ranked dash. For the AI competitiveness and ecosystem vibrancy, according to FDI Markets, India ranked dash in the global greenfield announcements, that is for the new projects in the AI related subsectors, such as data processing and semiconductors and light components in 2024-25. Third, yes, India ranked third for AI competitiveness and India ranked fifth in the global greenfield announcements. So D is the answer. Very good, everyone. So India ranked third for AI competitiveness and fifth in the global greenfield announcements. Next, very easy question, but such kind of question can come. So you need to remember that what are the reasons behind a particular thing. So in the context of domestic inflation management in 2025-26, which of the following policy driven, it has been said. That means from the fiscal policy or monetary policy, from the government side or from the Reserve Bank of India side. It is not talking about food. It is not talking about fuel or something. So which helped limit price pressures across several goods and services in September 2025. So implementation of export bans on no. Rationalization and simplification of GST rates. This is the answer. Everyone who is able to answer this question? Rationalization and simplification of GST rates. Any confusion? Next is yes. Next, try to answer this question. Driven by a 50 rupee hike per LPG cylinder in April 2025, the fuel inflation increased to 2.4% during April to December 2025. Now, the contribution of the fuel group to headline inflation increased to what percentage? That you have to tell. Anyone who is able to answer this? D is the answer here, 8.8%. 8.8%, okay? D is the answer. See, the fuel group's contribution to headline inflation increased to 8.8%. This is the idea. So fuel inflation increased to 2.4% during April to December 2025. Now this was the increase in the fuel inflation and it contributed 8.8% to the headline inflation. Now coming to the next question. During the year 2025-26, CPI food and beverages recorded its steepest deflation in October 2025 at 3.7%, while overall food inflation remained benign due to staples like vegetables, pulses, cereals. Which of the following subcomponents bucked this trend by witnessing upside price pressure? Fruits, oils, and fats. B is the answer. Yes, see, there are multiple things that you have to cover, but focus on the easy things right now. Easy things means that which you are able to grasp in a fast manner. Do not focus on such data that that is very hard, difficult to remember. Okay, just focus on the most important data right now. If a question comes from that, it is good. If the question is not coming from the most important data, so the less important data, many very less students will be able to remember it. Okay, so focus on the data that you are able to remember in a faster manner and write the data in the margins of the document so that you can remember the data in a faster manner. You have to also do the active recall in your brain again and again. You have to keep on recalling the data, and revision is a key. So even if you are doing the 3 months of coverage, focus on the revision. So B is the answer here. Next is the Financial Inclusion Index, which was first published in August 2021, improved to 67 in March 2025 from 64.2 a year ago. So is this correct? The Reserve Bank of India Digital Payment Index grew by 11% during 2025-26. India ranked fourth globally with installed renewable energy capacity exceeding 250 gigawatts. So first is correct because yes, the Financial Inclusion Index has improved from 64.2 to 67. Reserve Bank of India Digital Payment Index grew by 11%. This is also true. India ranked what? Globally with installed renewable energy capacity exceeding 250 gigawatts. It is not fourth. So what it is? So first and second is correct. Third is wrong because India ranked third globally. Okay. So India ranked third globally with installed renewable energy capacity. Chalo. So first and second statements are correct. Now coming to the next question. With reference to credit delivery initiatives and specific development programs in 2025-26, consider the following statements. Effective from April 1, 2026, the limit for collateral-free loans to micro and small enterprises was enhanced from 10 lakh to 20 lakh. We have discussed it again and again. It was quite in news recently also. It was in annual report also. A comprehensive review of the Financial Inclusion Index has been initiated by the department on completion of 5 years of its launch, because it was launched in 2021. Now there is the review that is happening, so the 5 years have passed. So first is correct, second is wrong. As on March 31st, 2026, 100% coverage has been achieved under the program in more than 80% of the districts across the country. So this is also correct. So first and third are correct, so C is the answer. Second is wrong now, because it is not in 3 years, it is in 5 years. Okay. A comprehensive review of Financial Inclusion Index has been conducted on completion of 5 years of the launch of Financial Inclusion Index. Okay, so 1 and 3 is the answer. Now, coming to the next one, under the lead bank scheme framework, which of the following represents the correct current institutional distribution of the lead bank responsibility in India? So, how many public sector banks and how many private sector banks? 12 public sector banks and 2 private sector banks. And these 2 private sector banks are which private sector banks? Jammu and Kashmir Bank and ICICI Bank. Okay? So 12 public sector banks, 2 private sector banks. The 2 private sector banks are Jammu and Kashmir Bank and ICICI Bank. Okay? Next, try to answer this question. RBI has allowed exporters. So which of the following statements is incorrect? RBI has allowed exporters using Bharat Mart in the UAE to realize and repatriate export proceeds within 9 months from the date of sale of goods. Absolutely correct. In the merchanting trade transfers, the timeline for the outlay of foreign exchange has been increased from 4 months to how many months? The theme for Financial Literacy Week 2026 was KYC, your first step to safe banking. Absolutely correct. In a major trade reconfiguration, UK has become the largest trading partner of India, overtaking the US. No, it is China, right? So first and second are correct, third is wrong. The center's debt to GDP ratio is budgeted to decline to 55.6%. Absolutely correct. And in the 16th Finance Commission also this was discussed that the target for 2030 2031 is to reach to 50% plus minus 1% of the debt to GDP ratio. Okay, so this is also important. As at the end of March 2026, the Reserve Bank's balance sheet size stood at 26.4% of the GDP. Yes. MTT, merchanting trade transfer, for the outlay of foreign exchange, the timeline has been increased from 4 months to 6 months. Chalo. C is the answer here. Now, coming to the next question. Very easy question. This is from your static part of the Financial Inclusion Index, that there are 3 parameters. What is the weightage of all these 3 parameters? Now, the Financial Inclusion Index, it does not have any base year. So, its value is in between 0 to 100. 0 means complete financial exclusion. 100 means complete financial inclusion. While for the digital payment index, there is the base year, that is March 2018 is the base year. In the DPI, there are 5 parameters. In the financial inclusion index, there are 3 parameters: access, usage, and quality. Access 35%, weightage, usage 45%, quality 20%. So B is the answer. And the financial inclusion index value has increased in the March 2025 because of the usage and quality parameters. Now, coming to the next question, India's foreign exchange reserves remained adequate in terms of the metrics of reserve adequacy, including import cover of about how many months and external debt cover of 90.3%. So, metrics of reserve adequacy, this is usually in the terms of merchandise trade, including import cover of 11 months. Okay? 11 months. Chalo. As per RBI Annual Report 2025-26, the revised co-lending directions have extended the first loss default guarantee cover up to what percentage? So, in the co-lending directions, we revised that, okay, the percentage of the co-lending minimum was for regulated entities was 20%. This has been reduced to 10%. And the first loss default guarantee cover up is up to 5%. That is allowed. So, 5% is the answer. Chalo. So this is what we discussed, that for the regulated entities, minimum share of the individual loans retained by the regulated entities has been decreased from 20% to 10% and extended first loss default guarantee cover up to 5%. So 5% and 10%. Now, try to answer this question. My birthday is not till 3-4 months more. As per RBI Annual Report 2025-26, what is the maximum asset size threshold proposed for exemption from registration requirements for NBFCs not accessing public funds and not having customer interface? Again, a lot of times we have discussed this recently only because the directions were released recently. NBFCs not accessing public funds, not having customer interface. Uh, these NBFCs are the type 1 NBFCs. They do not need to register if they have the asset size of less than 1000 crore. Okay? So C is the answer. Now, to strengthen banks' short-term liquidity resilience so that they have enough liquidity with themselves and further align with the Basel III liquidity standards, the liquidity coverage ratio guidelines were amended. As per RBI Annual Report 2025-26, what is the specific percentage of the additional runoff factor introduced for retail deposits with internet and mobile banking access, or for the unsecured wholesale funds from the non-financial small businesses with internet and mobile banking access? The runoff factor, additional runoff factor is 2.5%. Additional runoff factor is 2.5%. As per RBI Annual Report 2025-26, how many sutras form the core of the pre-AI committee's framework to articulate foundational principles? So dash sutras, dash strategic pillars, dash action points. So how many sutras are there? 7 sutras, 6 strategic pillars, and how many actions? 26. Chalo. Now, as per RBI Annual Report 2025-26, which of the following entities remain the largest holder of government securities as of end March 2026? Very good. Try to answer this now. Which of the following entities remained the largest holder of government securities as of end March 2026? It was commercial banks. After commercial banks, insurance companies and such. Okay? So commercial banks is the answer. So now coming to, as well as, see, the floating rate saving bond, it was also in news recently because the operational guidelines have been changed for the floating rate saving bond, and it was said that 12,476 crore was raised through the issuance of floating rate saving bond in the 2025-26, of which 1,067 crore was raised through Reserve Bank's retail direct platform. You don't have to remember it. This I have shown you because in the annual report, the FRSB is also mentioned. So again, this will be in news. Again, the operational guidelines are very important. That was discussed. Okay. So if you are focusing on 3 months, that is March, April, May. And the FRSB, I think, was released in Feb or March. I don't remember it clearly. If it is released in March, April, or May, then I will suggest you that do revise it thoroughly. Okay. If you are not covering beyond that, then it is fine. Now, coming to the homework question, this is your homework question again and again, like provision of what was made by the Reserve Bank of India. So basically, I always inform that such kind of numbers are usually not important. But if a number is coming again and again in news, coming again and again in different documents of RBI, then it becomes important. So RBI released the Central Board of Directors meeting in which it was informed again. Now also in annual report also it was informed and such. So basically, the economic capital framework requires contingent risk buffer to be maintained within the range of 4.5% to 7.5%. RBI has decided for 2025-26 to maintain the contingent risk buffer at 6.5%, for which the provisions have been added in the contingency fund of how much? This is your homework question. Okay? Next, as per RBI annual report, UPI continued to account for the largest share in retail payments, contributing nearly what percentage of the total retail payment transactions during the years? So do tell me out of 20 how many marks you have got, as well as For the homework question, do give the right answer of the homework question. I have put a lot of efforts to bring the concise material for all of you so that you can just go through these sessions. And I hope you like the sessions. This is it. From my end, the annual report is finished. Chalo. So do tell me that out of 20, how many marks you have got, as well as you have to tell me that the answer of the homework question. I hope you like the sessions. Especially go through the previous session, because like in this session, overview has been provided for the different chapters. The previous session is very important, in which the part 1 was discussed. So part 1, the part 2 is important. But in the part 2 you only need to have an overview. The part 1 is very very important, where you need to have the detailed, like the real GDP growth, real GVA growth, the assessment, the prospects, all of that is very important. Okay, so part 1 is also very important, so do go through the previous session. This is idea. Chalo, if you really like the session a lot, then do comment down below. Thank you everyone, thank you for joining.